Hey, Craig, we coming through loud and clear here, Craig? All right, perfect. Hey, David, how you doing? Ron, good to have everybody. Appreciate y'all being with us today. Hope everybody had a great weekend and off to a good trading week here. I'm going to get our recording going here and jump right in. So welcome everybody to the Nadex application and strategy webinar series. My name is John Skelton. I'm with Apex Investing, and today we're going to be going through this Nadex hosted webinar here and talking about live range-bound markets trading with Nadex. If you were with us last week, we talked about trading volatile markets, and in the past we've talked about trading trending markets, and today we're going to talk a little bit different. We're talking about range-bound markets. All right, I'm going to go through and explain to you what that is and show you some ways that you can trade it. You know, some people think, well, hey, you know, I understand how Nadex spreads work or binaries work, and I need movement in the market. If the market's not moving, there's really nothing I can do today. There's really nothing I can trade. And it's not actually always accurate. I want to show you why that is and some ways you can take advantage of it. So let's knock out our disclosures here so we can get rolling. Trading futures, options, or any financial instrument involves risk, may not be suitable for every investor. The information here in this webinar is for informational and educational purposes only and is not an offer or solicitation of an offer to buy or sell any particular financial instrument offered by Nadex, and past performance is not indicative of future results. Also keep in mind, any trade examples that I show you today are just examples. Just the same thing, they're there for informational and educational purposes only, just to give you an idea and explanation of the strategy I'm showing you, or to give you an illustration example of how to place orders on the Nadex platform and place take profit orders. Just kind of showed you how to get a feel of the actual platform itself and entering and exiting orders. It's in no way a trade recommendation by any means. So again, my name is John Skelton. I'm with Apex Investing. Apex and Nadex, two complete separate different companies. Nadex is an exchange. Apex, we're an online education company. We're a group of traders helping traders. We've got over 20,000 members here. We've got all kind of different strategies and systems. We focus a lot on risk management and probability. One of the reasons we love the capture risk products with Nadex, we're a Nadex education partner. We do these webinars each and every week for Nadex. We do them sometimes at different times or different days. And so keep an eye on the schedule here. Coming up over the holidays might be a little different than normal. But just a little about me. I've been with Apex now as head of operations for about 3 years. I've got a background in banking and as a stockbroker. And I'm a trader just like you. I trade Nadex binaries and spreads every day myself. You know, we trade them over in our room. We love the capture risk products at Nadex. And that's what we're here to do today, is just kind of help you understand who is Nadex, what is Nadex, how do the products work, and give you some ideas of some, you know, free education as far as how you can take advantage of these products, different ways you can trade them, and how you can trade them in different market conditions. And today we're going to talk a little bit about how to read market conditions. And this is so important. You know, you can have the greatest strategy in the world, the greatest system in the world. Let's say you have a great trending strategy, all right? And you've got a 90% win rate and a, you know, crazy great, you know, risk to reward ratio. But if you're trading that trending strategy during a volatile day or during a range bound day, it might not work out for you, right? And so what you have to understand is, you know, understanding the instrument you're trading, understanding your, you know, ABC 1, 2, 3 rules of your strategy or system is great. But what's equally important is being able to read the markets, to understand, you know, what type of strategy you need to use that day. Okay, just like you've heard me make this analogy before, whether, you know, if you're a golfer, you know, you don't just use one club the whole game, right? You check your surroundings, you understand the conditions of the course and, you know, of that particular green, and what, you know, what club do you use? Or you've heard me use sports analogies, whether it's, you know, football or basketball, or, you know, no one wins a football game by running Hail Marys every play. You know what I mean? You have to understand, you have to have different plays in your book and understand when to use them. And that's part of the reason that we switch these subjects up every so often. And we've talked about trending, or last week we talked about volatile, and today we're talking about how to read the market conditions, how to pick the right binary strike. We're going to talk about some risk management, how to understand what is a range-bound day. We're going to talk to you about what's called a butterfly strategy, okay, just to help you have these different plays in your playbook. So first of all, I want to real quick talk about in-the-money binaries. All right, last week when we talked about volatile markets, we were talking about how to use, the out-of-the-money binaries. So I just want to pull up something real quick here. Let's pull up, let's check out the Nasdaq. Let's pull up the US Tech 100, and let's look a little further out. Let's go to 1 p.m. today, and here is the Nadex platform, and here is your strike ladder. This shows all the different binary contracts that expire at 1 p.m. Okay, and over here on the offer side, you see the price you can buy for. On the sell side, you see what you can sell for. Okay, and you'll notice, for example, just on, let's look at the buy side here, it goes from $4 to $97. On the sell side, it goes from 50 cents to $95. So what is an in-the-money binary? What I want to do here is, if you click right here, see any one of these binary contracts here, you can click this arrow. Right here, you can pull up a binary ladder chart. And I want to do that real quick just to kind of help us visualize what I want to show you here. And we're going to talk a little bit about the difference of in-the-money binaries and at-the-money binaries, just very briefly here. Now, for some of you, this is, some of you veterans, this is very elementary to you. You get that. But if any of you are new with us today here, I want to cover this just very briefly, and then I'll show you where you can get some more information. If anything we cover today here is kind of over your head, don't worry. I'm going to show you, just stick with us. I'm going to show you at the end here where you can go back and catch up on some basics. So this is the Nadex platform. This is a binary strike ladder chart. So this is a chart showing you where the market is. And over here, it gives you an example of where these binary contracts are. Okay, remember we were over here looking at the binary strike ladder where they're all listed out. Okay, and you can see right here the indicative price. This shows you where the Nadex, indicative price is. Where's the market at right now in comparison to these different strikes you're looking at. But if you want a really good visual of it, you can pull up this strike ladder, and it shows you on the chart itself, okay, the market's right here at 49.51. What are my options? Okay, I've got some binaries up here, I've got some binaries down here. Now I want to show you something. Notice the market is right here. Notice this close by binary right here, okay? This is what we're going to call an at-the-money binary. Notice you can sell it for 52, buy it for 58. Okay, now real quick, I want to show you one other thing here. Let's take a look at, the dailies later today. Okay, where is the market at right now? 49.51 is where the indicative is. Okay, notice there's all these different strikes. Well, look at this one right here, 49.52. Well, 49.52 is the strike. 49.51.1 is where the market is. So this strike is the closest strike to where the current market is. And notice about where it's priced at. I can sell it for 45, I can buy it for 53. So kind of if I looked right in the middle between those, it's about 50 bucks, right? If you understand the basics of a binary, at expiration, a binary is either worth 0 or 100, okay? And what is a binary? Well, all a binary is saying, if I was to click this and open this, all a binary contract is simply a statement. This statement says the US Tech 100 will expire greater than 49.52 at 4:15 today. Okay, that's it. That's what a binary contract is. It's either 0 or 1, true or false, yes or no. This event will happen or will not happen. If I think yes, it will happen, then I want to buy the contract. If I think no, it will not happen, I think the market will be less than 49.52, then I want to sell the contract. And at expiration, a binary contract is either worth 0 or 100. Okay? So at expiration, it's either worth 0 or 100. Well, before expiration, okay, for the most part, now it can get a little volatile right close to expiration when the market's just hovering right there at it. But in general, when notice again, 49.51.9 which is almost exactly 49.52. So when the strike price and the indicative price are right close to each other like that, you're going to see the binary contract priced approximately around 50 bucks. Again, it can get very volatile right towards expiration, but in general it's going to be right at $50. Well, why is that? Well, at expiration it's either got to be over here at one extreme at 0 or another extreme at 100. But if it's right there on the line for a while, it's kind of still 50-50. Is it going to be above it or below it, right? So we understand why a binary contract is priced around 50. Okay, and that's an example of not just something that expires here at 1 p.m., but also something that expires down here later today. What about the weeklies? Let's look here. Well, market's at 49.51, and let's see here. The closest one is going to be right here about 49.44 or 49.56. Again, notice right around 50 bucks, even at the end of the week, 3 days to go. All right, so whether you've got 20 minutes, an hour, a day, or a week, you can pretty much count on, unless you're right there at expiration, if the strike price and the indicative price are right at the same, binary is going to be priced right around $50. Okay, so why, for example, would this one right here be priced at 76? Why is it priced closer to 100? Well, that's what we call an in-the-money binary. Well, what does that mean? Well, right here, this strike price is what? 49.46. So if I were to buy this, what am I saying? I'm saying that at expiration, the market will expire greater than 49.46. Well, the market's already greater than 49.46, isn't it? It's already above 49.46. So that's why it's not priced at 50. It's priced closer to 100 because the statement's already true. Right? Does that make sense to everybody? So if I were to buy this contract right here and the market continues to go up, at expiration, if the market had continued to go up, would this binary be profitable or not profitable? Just a quick little raise your hand here, see if everybody's paying attention. Yeah, it would be profitable, right? Okay. What if the market just kind of went flat, just stayed right where it is? Like just didn't have a heartbeat, just flatlined right there, just didn't move. At expiration, it would still be profitable, right? Because it's still above 49.46. What happened if the market came down and expired at 49.47? Still profitable, right? Because the statement is it has to be above 49.46. So that's an in-the-money binary because the statement's already true. So as long as it stays true by expiration, then the binary will expire and be worth $100. Now that's an example of the buy side. What about the sell side? What about up here? I can sell, this binary strike is 49.58. Again, you see how very clear it is when you use the strike ladder charts here on the Nadex platform. You really get a visual of what your options are. What about this one right here? 49.58. If I was to buy this, I can buy it for $31. But what am I saying? Saying that the market will expire above there. So the market has to go up, right? It has to move. And it has to move a lot and has to move in my direction. But on the sell side, so this is an out-of-the-money binary on the buy side. But it's an in-the-money binary on the sell side, right? Because if I sell this binary, what am I saying? I'm saying, hey, I don't think this statement's true. I don't think it'll expire above 49.58. I think it'll expire below 49.58. So I can sell it for right now $23.50, right? And that's an in-the-money binary. All right, so if I sold it right now for $24, if it expired in the money, my profit would be $24. Okay, so we know that those are in the money binaries because the statement is already true. Now let me ask you a quick question here. If I was to buy this binary right here for $76.50, okay? And what would happen, not at expiration, but before expiration, if the market came down all the way right here to the strike at 49.46. What do we know based on the examples I just showed you? I bought it for 75. If the market comes down and hits that strike price before expiration, what do we know approximately that binary will be worth? About $50, right? So that binary is no longer an in-the-money binary. It becomes a what? An at-the-money binary, because the market price and the strike price are right in line. So we bought it for 77, but if the market comes down and hits it, before expiration with some time to go, it's going to be worth about $50. So we get that, right? Okay, so just setting a quick kind of foundation there to help you understand where we're going with this. And again, if any of you are new and this is kind of over your head, don't worry. I'm going to show you where you can go and get step-by-step, very basic understanding of binaries, in the money and at the money and out of the money binaries. So in the money binaries, they have a higher probability, right? We can understand why there's a higher probability because the statement's already true, right? It's a higher probability because the market can go up, the market can stay flat, the market can come down, but as long as it doesn't come all the way down to us, we still expire in the money, okay? So it's definitely from a number, a probability standpoint, a higher probability, but in a sense it is a higher risk because we're tying up $75, right? We're risking technically $75, $80 instead of only 30. Okay, so you have a higher probability, but you have a little bit higher risk if you don't close it out before expiration. And you've got choices available. All right, there's not just one choice available normally. I mean, for example, this right here is an in-the-money binary that we can get for 68, 66. This is an in-the-money binary that we can get at 80, and this is an in-the-money binary at 91. Okay, so you've got some options there. All right, and even going the other way, we could scroll up and we would see that we've got, some different options as far as in-the-money binaries here, and even further. So you've got more than just one in-the-money binary most of the times. All right, so you've got great options there with Nadex. So what is a range-bound strategy? Some days the market is not trending. All right, sometimes you open a chart and it's very clear the market's shooting straight up or shooting straight down. All right, we talked about needing to have multiple plays in your book and be able to adapt to the different market conditions. And especially if you're a new trader, you need to understand there's not one single strategy or system that works 100% of the time. All right, every system has losses. All right, it's about, what is your, your ratio, and no single system is going to work in all market conditions. So what is needed for a range-bound strategy? Meaning when the markets are just flat, they're not really moving, okay? So let's think about something. If the market is just flat and it's not really moving, do we want to, let's pull this back up here. If we've got a day where the market's just flat, for example, it's not shooting straight up or shooting straight down, it's just flat. Do you think you really want to sell a binary way down here, therefore saying that the market's going to shoot way down? Or do you think that you really want to buy a binary way up here, saying that the market's going to shoot way up? I mean, what is really telling you that that would happen? All right, what are you reading the market conditions to just randomly say, oh, I like this. This is only a $20 risk. So I'm just going to say the market's going to go way up there. What do you have that's telling you that? Right? So those way out of the money binaries might not necessarily be your best choice if the market's just flat, right? So let's take a look at something here. This is an example. Any of you that were with us last week, we talked about volatile market days, okay? And I just want to cover this chart again with you here, and then I'll show you where you can go and watch last week's webinar because I want to show you the difference. What is a volatile day? Well, a volatile day is not necessarily a trending day. It's not necessarily that the market's shooting straight up or shooting straight down. But let's back up for a second, just look at this chart. What is all this stuff on the chart? Well, I don't want you to be confused or overwhelmed on this. Several things here on the chart. These are some of our Apex proprietary charts and indicators. First thing I want to bring your attention to. See these squares on the chart. This is what we call our expected range indicator. Okay? What this does is this goes through and it basically looks historically at, you know, this week of the month, this day of the week, this hour of the day, and these minutes of the hour. Historically, what is the expected movement of the market for this time frame? For this time frame, what is the expected high and what is the expected low? On this particular chart, if you notice, I have these on 20-minute time frames. You can see right here where this new square started right here. Okay, would have been at 1300. Right here where it ended was at 1320. So these are 20-minute boxes, okay, because at the time I was looking at 20-minute binaries. So if I was trading this live, like you can see over here, this box is already drawn out for the next 20 minutes at the start of the 20 minutes. So I can see, looking forward to the next 20 minutes, what's the expected move of the market, okay? It's not historically been higher than this or historically been lower than this. Okay, that's what we call our expected range indicator. Now, we talked about how in volatile days we see that the market kind of comes towards the high of that range and then comes towards the low of that range and pops back up to the high of the range and comes down to a low or even shoots through it. Okay, that's showing us that the market is moving. It's hitting those expected highs or lows, or it's breaking out beyond what it historically does. So when you see that historically the market shouldn't go above or below these higher lows, but you see it hitting those higher lows or breaking those, that shows you there's some volatility going on, right? There's some movement in the market, right? The other indicator that I showed you last week that I want you to pay attention to is right here, the expected volume indicator. It does the same thing, all right? It looks back historically of what's the expected volume for this day of the week, time of the day. And remember I explained to you this yellow line right here? That's historically the volume level for this time frame. Okay, the blue is showing you the current level of volume. So what do we see in here on this volatile example, especially right here? What do we see happening? Well, this yellow line was the historical volume expectancy. But the blue is showing you the actual current volume. It's blowing way through it, right? Saying what? Saying it's a lot higher volume than usual for this time frame. There's a lot higher volume than expected. What do we see happening right here as well when the volume's higher? We see the market breaking out of its expected range of movement. Right here where it's really blowing through, we see it blowing through that expected range of movement, right? So we talked about that last week, of how to identify market conditions, how to identify a volatile market. And that's one of the ways we do it is, where is the market going compared to its expected move, and what is volume doing? Okay? In a nutshell, everybody understand that? So now I want to show you something. I'll show you a different chart. Okay? What do we see different on this chart right here? Okay? What do we show different here? Well, we see the market staying within these ranges, right? We don't see a lot of crazy pushing out of the ranges, do we? Also, look at the expected volume indicator. Are we seeing the market blowing through expectations? Or are we seeing it right about where it's expected or even less than expected? You see that? Does everybody see the big difference there? Oh, there's a difference there. There's an example of the difference between a range-bound market and a volatile market. Okay, and that's where it comes in. Yeah, David says it's very smooth. Yep, it's staying between its expectations there. There's not a whole lot going on. It's not breaking out. We're not seeing a lot of crazy volume. So if I'm looking at this day, I could say, well, all right, how do I trade something like this when the market is just flat? I don't expect it to move a whole lot. So if I don't expect the market to move a whole lot, do I want to buy this binary way up here? Well, why would I buy that binary way up there? I would be saying that the market's got to move a whole lot. But my chart and my indicators, the way I'm reading the market, showing me that's not what's happening. It's going to be staying in this range here as an example. So what could I possibly do? Okay, what could I possibly do to take advantage of a day like this? Well, let me show you here a couple examples here. So if I'm looking at this, if I'm looking at this chart here, all right, let's say I'm looking at these 20-minute binaries, and let's say that I'm going into the next 20-minute session of binaries. And I'm looking back and I see, okay, volume's not exceeding, the market is not breaking really these ranges. What I could do is I could say, okay, well, if I don't think the market's going to go higher than this right here, what could I do? I could sell a what? An in-the-money binary. And what am I saying if I sell an in-the-money binary? Well, let's look back at the ladder again here. And again, this is all just for illustration purposes showing you here. Okay. All right, let's go back up here. Let me just pull this back a little bit. Okay. So if I thought, okay, I see that the market is range bound. It's not moving much. What happens if I were to sell this binary right here? Okay. Or this binary right here? These are both in the money binaries, right? And if I sell these, what am I saying? I'm saying that the market is going to stay below this level, right? So I've got a couple different options here, okay? I could say, all right, I want to sell this one or I want to sell this one. Now, how would I maybe look at my options there to decide? Well, if I'm looking at my chart here, I'm probably going to want to get the closest possible strike to the top of this range here, right? Does that make sense? I want to try to get as close to the top there as possible, so to give myself a little more room. And fortunately, I've got more than one option here with Nadex. I've got two different strikes I can look at. So let's just say I sold, for example, this one right here. What am I saying if I sell this binary strike? I'm saying that the market will not expire greater than 49.58. Because remember, I'm expecting to stay within a range. What if at the same time I also came down here and I looked at these couple of different in the money on the buy side? And let's say I bought this one right here for 75. What am I saying when I buy this one? I'm saying that the market will expire greater than 49.46. So with this particular strategy, what we call a butterfly strategy, what I'm looking for is what? I'm looking for and I'm expecting the market to stay within a range. I'm not expecting it to break out of that range. I'm expecting to stay in that range, right? Okay, so what I'm looking at here is I just created a range. All right, and I can use either, this binary option. I can use the one above it. I can use either one of these on the buy side. I've got a couple different options. But if I, as example, went with this binary on the sell side and this one on the buy side, what I'm doing is giving myself a range that as long as the market expires above this level and below this level, expires anywhere in this range, then both of the binaries would expire profitable. Does that make sense? Does everybody understand what we did there? We're selling up here, saying the market will stay below this level. At the same time, we're buying a binary down here, saying it will expire above this level. So even if the market's just sitting here back and forth, that's what we want. That's what we're looking for. So again, sometimes you see those flat days where the market's just not doing a whole lot and you think, oh, I can't trade directionally, I can't trade Nadex binaries or spreads today. Well, actually, that's not the case, right? Now, yes, you have to look at what are your expected ranges there, what's your expected highs and lows, and what is your options here on the Nadex platform. And once again, that's where this price ladder is extremely helpful for you to be able to compare your charts side by side with this ladder, look at what are your different options here, and choose which one is best for you. Okay, so that's how we look at how to determine the market condition and how we want to trade them. Again, if it's a range-bound day, a flat market, we're looking to both buy and sell an in-the-money binary. All right, last week we talked about if it's a volatile market shooting way up and down, we're looking to both buy and sell an out-of-the-money binary because we're expecting movement. Okay, and I'm going to show you where you can go back and watch that webinar to make sure you understand the two differences there. Okay, so real quick here, let's go through and talk about how to manage that trade. Okay, let's look at something here. I'm going to actually go back to this. Let's say that we did that. Let's say that we sold right here. Okay, or let me show you an example of one that I did here. All right, so on this particular chart here, all right, going into the 4 o'clock expiration, okay, I bought at the top of the range for 82.50, and I sold, or I'm sorry, I bought at the bottom of the range for 82.50, and I sold at the top for 19.50. So if both of these were to expire in the money, I would make 19.50 on the sell side and about 17.50 on the buy side, right? So let's just, for numbers' sake, let's call it about 40 bucks. Okay, so if both expired, so again, if we're looking at this here, if I sold up here and bought down here, okay, I'd make about 25 on this one and about 19.20 on this one. So I would be looking to profit about, let's just say $40, correct? Everybody understand that? Now, what's the first thing you're telling yourself? You're like, well, hold on. This all sounds great, John, but wait a minute. If I buy this one for $77, I'm risking $77. Also, at the same time, I'm also selling this one for about $20, which means I'm risking $80 over here. So, John, you're telling me to risk $70 on one side and go over here and risk $80 on the other side? Wow, that seems like a lot of risk to potentially make 40 bucks, right? Okay, and in general, I would understand that, right? If you're risking, say, 160 bucks to make 40, that might not quite be the risk-reward ratio that you're looking for, right? Well, let's talk about something. How do we manage this trade? If we had placed this trade, how would we manage it? Well, let's say that we sold up here and we bought down here, expecting the market to just stay in the middle. Let's say that we're wrong and the market starts coming on down, starts coming on down, starts coming on down, and it gets all the way down to right here at this strike. Well, we sold this for 20. If the market comes way down here, this is going to be even more in the money, right? We sold it for 20, it'll probably be worth about what? 15, you know, we'd probably be up profitable close to 15 or 20 bucks on that, right? So if the market came down here, we'd probably be up $15 in profit on this trade. Does that make sense? Does everybody understand that? If we sold this at 20 and the market comes way on down, it's going to get closer to zero, right? We'd probably be up about $15 in profit. But where would this one be if the market came all the way down to 49.46? We bought it for 75. What do we know it's going to approximately be worth if the market comes down here to this price? We talked about this earlier. Anybody remember? We bought for 75. The market comes down and hits this strike price before expiration. It's going to be worth around, yep, exactly, 50. So how much would we have been down in that trade? What would our loss be on this trade right now? if we bought for, on the buy side, if we bought for 75 and now it's worth 50, we'd be down $25, right? Okay, so what we can do is we can say, all right, how do I manage this trade? Sold up here, I bought down here, expecting to stay in the middle. If I'm wrong and it comes down and hits my strike price on either side, I get out. Okay, so if we bought for 75, it comes down here and hits that strike price, it's worth 50, we get out, and we're down how much? We're down $25, right? Marvino, Arthur, Ron, Stephen, Paul, yep, everybody said we're down $25 on this side. But again, if the market came all the way down here, remember this was at 20 when we sold it, and we're saying, you know, the market's going to be below that. If it came on down further, this will probably be worth like 5, so we'd probably be up about 15 bucks on this side, right? So we lost 25 on this side, but we made 15 on this side, approximately, right? So how much did we end up really losing? And let me just clarify something with this strategy. If it hits this strike level and we exit at 50, we automatically close this side out as well. So we're really down about $10, right? So yes, we had to tie up 75 on the buy side. We had to tie up 80 on the sell side. So we had to tie up, you know, some money out of our account. But if we followed this, the rules of this strategy, we're not necessarily looking to risk $160, are we? No, we're really looking to risk like $10, $15 with a potential reward of what? About $40 if they both expire in the money. So that all of a sudden is a pretty nice risk to reward ratio, isn't it? Risking 10 or 15 to potentially make 40. Okay? So does that help you understand? A few light bulbs kind of go off there of like, oh, okay, I can trade those range-bound days. I do see how that works. Okay? Now, does everybody understand that if the market did hit this here, we would exit at around 50, and at the immediate same time, we'd exit this one. Okay, why? Well, what happens if the market comes down here and hits this and we exit it, but we leave this one open just in case we can make another 5 or 6 bucks, and then the market comes all the way back up here and hits this one. We don't want to do that, right? So that gives you an idea there of some ways you can trade these range-bound markets and how to manage that trade. Now, guys, don't just blindly take these. Don't just start taking, oh, I'm going to go and buy and sell one of these in the money every 20 minutes and every hour. No. Don't blindly take them. Have a reason to. Make sure you're looking at volumes and ranges and expected moves. Make sure you're reading the market. Don't just take something based on a price or a good risk-reward ratio. Make sure to demo trade them first. Okay? So where can you get some more information about how to kind of help you understand this trade? If you go to nadex.com, I want you to go here to the Learning Center. Go right here to Webinar Archive. Okay? And then once you get there, just right here, filter by presenter. Just filter down here to Apex Investing Institute. You can see some of our past webinars. Okay? One of the ones you definitely want to watch is last week's webinar when we talked about how to trade volatile markets. Today we're talking about range-bound flat markets. Last week we talked about volatile markets. And then this webinar right here we're doing is being recorded, and this is where you'll find this webinar here. Okay? So you can go back and watch both of them to compare them to make sure you understand the differences of the strategies and how to read the markets. You can also scroll down here, and right here, binary strangles and butterflies is another webinar we did where we talk about both of these strategies in a little bit more detail. And you can go through and watch excuse me, some of these other webinars here about choosing the right binary for your strategy as well. For those of you that are brand new and still not even understanding some of the basics of binaries, page 2 right there, Nadex Binaries 101. Okay, so if you want to get some more info on this, fill in the blanks, hop on over to nadex.com there, check out some of those historical webinars, and feel free to visit us over at apexinvesting.com. We've got hundreds of hours of free education over there, some step-by-step training courses on binaries and spreads. You can watch step-by-step training courses on some of these strategies here that I'm talking about, but in a lot more detail, and really help you understand how they work, how to do them, and particularly how to read the market conditions. Okay? If you have any questions at all, feel free to hit us up over there, over at Apex in the forum or in a live chat or help desk ticket. More than happy to answer any questions you might have and help you get on the right path there. So, all right, guys, I appreciate your time today and appreciate your interaction here. Thank you for joining us, and I hope everybody has a great trading week and a great holiday and Christmas weekend coming up here with your friends and family, and enjoy it and be safe. Have a safe and great holiday.